JP Morgan CEO Jamie Dimon has been telling anyone who will listen that there are storm clouds gathering on the horizon, and he's not wrong, but the real danger isn't the storm you see coming. It's not just about inflation or interest rates. The real story, the one that could turn our predictable market correction into a full-blown catastrophe by the end of 2025, is buried deep inside the financial system. It's a story about regulatory loopholes, reckless tech gambles, and a hidden time bombs that the big banks are either actively exploiting or dangerously underestimating. These aren't the risks they talk about on the evening news, they are the risks they hope you never figure out. In this video, we're going to drag them into the light. I'll expose exactly what these hidden dangers are, how they connect to the market, and most importantly, what you can do to protect yourself before it's too late. Okay, so let's start with the official story. This is what every financial analyst gets paid to tell you, and to be clear, these risks are very real. The market is standing on shaky ground. We're seeing valuations that are frankly eye-watering, expensive. As of late 2025, some key metrics are flashing red. The forward price to earnings ratio is sitting around 20 to 21, and the Schiller KP ratio is hovering around 34. Both are historically high levels that suggest the market is priced for perfection, leaving zero room for error. The Bank of England has already warned that there is a growing risk of sudden correction, pointing a finger directly at the sky-high valuations of AI-related stocks. Then you have the engine of the economy itself, which is starting to sputter. The OECD projects that US GDP growth will slow to just 1.7% in 2025, a pretty significant drop. This slowdown is happening while companies are sitting on a mountain of debt, around 34 trillion in corporate bonds globally as of late last year. And here's the really scary part, nearly 30% of that debt is set to mature in the next 3 years. Think about what that means. Companies will have to refine trillions of dollars of old cheap debt at today's much higher interest rates. This isn't some theoretical problem. The OECD's latest debt report points out that a lot of borrowing over the past decade wasn't even used for productive investments. Instead, it was funneled into things like refinancing other debt and paying shareholders. So many of these companies aren't more profitable or productive, they're just in more debt. And in persistent geopolitical tensions, uncertainty around trade policies, and a Federal Reserve trying to land a 747 on a tightrope, and you got a story you hear everywhere. A market correction of 10 to 20% doesn't just seem possible, it feels probable. But a correction is one thing. A crash, a systemic collapse, that's something else entirely. And for that, you have to look a lot deeper. The mainstream narrative is that banks are stronger than ever, that the rules put in place after 2008 made the system foolproof. That's not just an oversimplification, it's a dangerous one. While the front door might have new steel lock, the banks have quietly propped open a few back windows. The real story, the one that could pour gasoline on a market dip and turn it into a disaster, is happening in the shadows. It's a trifecta of hidden risk, regulatory games, unchecked technology, and a fraud epidemic they can't seem to control. And this isn't just me speculating. The most powerful people in finance are dropping hints. When Jamie Dimon was recently asked about a few corporate bankruptcies tied to shady loans, he said there's always more than one cockroach. He's telling you that the problems you can see are just symptoms of a much bigger infestation. But what they don't do is give you a map to find the rest of those cockroaches. They frame the issue as isolated incident, not as a crack in the entire foundation. And this is where the idea of us versus them isn't just a figure of speech, it's a reality. There's the information they are willing to share, and then there's the reality of the risk they're managing behind closed doors. Our job is to bridge that gap, so let's start digging. So the first hidden risk is the most technical, but it's arguably the most important. It's called regulatory arbitrage, and it's happening right now with the final rollout of the Basel III banking standards. After the 2008 meltdown, global regulators created the Basel III framework. The goal was simple: force banks to hold more capital in reserve so they could survive a crisis without another taxpayer bailout. It's like telling someone who lives in a hurricane zone they need a strong foundation. It just makes sense. The final pieces of these rules are being put in place right now in 2025, and this is where the game begins. So here's the problem. Nobody's rolling out the same way. The EU started applying the new package on January 1st, 2025, but they've already delayed certain market risk rules. The US is starting its transition on July 1st, 2025, but it's a 3-year phase. In other places like the UK are on their own schedules. This staggered, inconsistent mess creates a global shell game. Imagine if every country decided to enforce new safer car manufacturing standards, but they all did it on different dates with different rules. What would car companies do? They'd exploit the difference, moving production to the countries with the weakest or most delayed rules to save a buck. Banks are doing the exact same thing, but with financial risk. A Basel Committee report from this month, October 2025, shows that while some progress has been made, implementation is still fragmented. For example, new standards for operational risk are in place in about 80% of member countries, but the critical market risk standards are only in effect in about 40%. This lets global banks shift risk assets to subsidiaries in regions where the rules are looser. They can essentially shop for the best regulation to make their balance sheet look safer than it really is. This isn't illegal, but it completely undermines the entire point of the regulations. It allows hidden pockets of risk to build up totally unseen until it's too late. The second hidden risk is sitting on the desk of every bank CEO: artificial intelligence. AI is being sold to us as the future of banking, a tool that slashes costs, approves loans in seconds, and detects fraud instantly. And it can do those things, but the bank's frantic race to adopt AI is creating a massive unmanaged risk they are not prepared for. According to a recent study by Boston Consulting Group, fewer than 1 in 4 banks are actually ready for the AI era. The other 75% are stuck in pilot programs, rushing to integrate AI without the right strategy or governance to control it. They're handing over the keys to critical functions like credit decisions to black box algorithms they don't fully understand. Think about it, traditional risk management in banking was built for humans with audits and paper trails. Modern AI models learn and change on their own. What happens when the AI model that decides who gets a loan learns a new pattern from market data and suddenly cuts off credit to an entire industry, triggering a crisis? Who is responsible? The risk isn't just internal either. Banks are increasingly relying on outside fintech companies for their AI. This just adds another layer of secrecy. The bank might not even own or understand the code its entire loan portfolio depends on. This makes it incredibly difficult to manage compliance, let alone the basic risk of the system just failing. The Bank of England admits that the high level of uncertainty makes it challenging to assess the long-term impacts of AI. While they talk about the benefits, they also warn that AI could wreck established business models and impact the creditworthiness of entire economic sectors. Banks are marketing AI as a symbol of innovation. The hidden reality is that they are building a technological house of cards, adopting powerful but poorly understood systems far faster than their ability to manage them. Okay, so we're deep in the weeds now, and if you've stuck with me this far, it means you're serious about understanding what's really happening. This is the kind of analysis you won't get on the evening news. If you're getting value from this and want to stay ahead of the curve, take 1 second to hit that subscribe button and turn on notifications. My job is to give you the map, so let's navigate this together. The third hidden risk is one that hits banks right in their bottom line and their credibility: the explosion of fraud and cybercrime. Making everything digital has been convenient, but it has also opened the floodgates for criminals. The sheer volume of attacks is overwhelming the resources of many banks. The problem isn't just the money being lost, it's the potential for it to be swept under the rug. When a bank gets tens of thousands of fraud alerts a day, it becomes a massive triage operation. So what's the incentive? Don't you go public with the full ugly truth about your losses and risk a panic? Or do you quietly absorb some of the smaller losses, write them off as a cost of doing business, and hope the bigger problems doesn't see the light of day? I mean, this isn't a conspiracy theory. We're already seeing those cockroaches Jamie Dimon mentioned. Recent bank losses have been tied to bankruptcies involving corporate fraud and weak lending standards that were somehow missed. One regional bank just pre-opted a $50 million loss tied to a fraud in its real estate portfolio. These are just the ones that have become public. How many more are being managed quietly behind closed doors? This creates a systemic fragility. A bank's greatest asset is trust. If it were revealed that a bank has been systemically hiding its fraud-related losses, that trust could evaporate overnight. It could essentially trigger a modern-day bank run where deposits are pulled not by people in line but with few clicks of a mouse. The speed of digital banking cuts both ways. So now we have the 3 hidden risks: the Basel shell game, the AI double-edged sword, and the rising tide of fraud. How do these lead to a 2025 stock market crash? Well, these are what risk managers call accelerants. They are the hidden fuel poured all over the economy that can turn a small fire into an inferno. So picture this: the market starts a standard 15% correction correction, triggered by one of the official reasons, disappointing growth, a geopolitical shock, whatever. As asset prices fall, the pressure on the system begins. Suddenly, those hidden risks start to buckle. A large bank that used regulatory arbitrage to hide its leverage gets a margin call it can't meet, forcing it to sell assets into a falling market. This forced selling pushes prices down even further. At the same time, an AI trading algorithm that was never properly stress tested for this environment misinterprets the volatility and starts selling indiscriminately, amplifying the crash. Or an AI credit model suddenly downgrades a massive portfolio of loans, freezing up lending for an entire industry. And just as panic sets in, news breaks of a major previously hidden fraud scheme at a mid-sized bank, shattering the fragile trust in the system. People start questioning if their own money is safe, and the digital bank run begins. This is the accelerant effect. Each hidden risk feeds on the others, creating a domino effect that regulators can't control. It's the ghost of 2008. The trigger back then was the housing market, but a catastrophe was caused by the hidden unregulated derivatives secretly woven throughout the system. Today the triggers are high valuations and a slowing economy, but the systemic accelerators are regulatory loopholes, unchecked AI, and massive operational risk. Okay, so look, hearing all that can be overwhelming, but fear isn't a strategy. A plan is. So what's the blueprint for protecting yourself in this environment? Well, first you need to take a hard look in the mirror. Are you overly concentrated in the same high-flying tech stocks with stretched valuations? Are you personally over-leveraged with debt? In a downturn, leverage is a weapon that turns against you. You have to know where your own risks are. Second, it's time to de-risk and diversify intelligently. I don't just mean buying a different flavor of tech stocks, I mean looking at true diversification. This could include tangible assets like gold, which often does well when people lose faith in paper money. It could mean holding a larger normal cash reserve ready to deploy when the assets go on sale. It means having some high quality bonds to provide stability when stocks are tanking. The goal is to build a portfolio that can withstand a shock, not just one designed to hit home runs in a bull market. Remember, I'm not a financial advisor. This is for educational and entertainment purpose only. Third, stress test everything. Ask yourself the hard questions. If your portfolio dropped by 30%, would you be forced to sell? Or could you afford to wait it out? Do you have an emergency fund to cover at least 6 months of expenses if your income vanished? Dealing with these questions now is infinitely better than being forced to find answers in the middle of a crisis. Fourth, and this is the big one, learn to watch the smart money. Don't listen to what the bank CEOs say on TV. Watch what their institutions do. Are they increasing their loan loss provisions? Are they quietly deleveraging and hoarding cash? Following the actions, not the words, of the most informed players gives you the most accurate map of what's ahead. So will the stock market crash by the end of 2025? Well, the risk of a severe correction is undeniably high. But the true danger, the thing that could turn the correction into a general crash, lies hidden within the banks. We've seen the message rollout of Basel III is letting banks play a shell game with risk. We've seen how the reckless rush into AI is creating tech vulnerabilities they aren't equipped to handle. And we've seen how the rising tide of fraud threatens the trust that holds the entire system together. The financial system is by design opaque. It's built to benefit the insiders. But knowledge is power. By understanding these hidden loopholes, you go from being a pawn in their game to an informed player. You can't control the Federal Reserve and you can't rewrite banking regulations, but you can control your own balance sheet, your own portfolio, and your own plan. The system is designed to keep you unprepared. It's your job to defy that design. What's one step you're taking this week to make your financial life more resilient? Share it in the comments below. Let's build a community of prepared, informed investors. Thank you for watching, and I'll see you guys in the next video.